every single day. At exactly 10:00 a.m. Eastern Time, the moment American stock exchanges opened, the Bitcoin price dropped like a clockwork, without fail, for months. This wasn't the market. This wasn't fear. This wasn't regulation. This was a machine, an algorithm, a $60 billion Wall Street firm with the most advanced trading computers on the planet, selling Bitcoin every morning at the exact same time. And while your portfolio bled out, while you refreshed the charts and asked yourself what you were doing wrong, they were buying it back, cheaper, profiting from the crash they created. The allegation of the 10 a.m. dumps gained traction when Jan Happel and Jan Alleman, the co-founders of Glassnode, posted a series of hourly charts showing consistent drops at exactly 10 a.m. ET every day from October 2025 onward, directly pointing to Jane Street as the source. Happel and Alleman are the minds behind Negentropic, one of the most respected institutional data accounts in the industry. They don't just look at price, they look at the digital DNA of the network. I'm going to show you exactly who Jane Street is, what they allegedly did, and why a federal court in Manhattan is now trying to hold them accountable. Stay until the end, because the last part is what nobody is talking about. The setup you were sold. Let's go back. Bitcoin hit $125,000, all-time high. Every influencer was screaming buy. The ETF approvals had just happened. BlackRock was in, Fidelity was in, the institutions were here. This was it. You believed in the thesis. Maybe you held since 30K, 40K, 60K. Maybe you bought in at the top because you didn't want to miss the run. Maybe you had a little bit. Maybe you had everything. Then something changed. Quietly at first, the price stopped going up. It started drifting down. Then the drifts became drops. Then the drops became a pattern. And the pattern had a timestamp. 10 o'clock in the morning, every day. You could set your watch by it. Data point. Bitcoin fell from an all-time high of over $125,000 to approximately $62,000. This was a drop of more than 50% over the course of just a few months heading into early 2026. Retail investors who bought near the peak needed a 100% plus rally just to break even. Enter Jane Street. Here's where most people stopped looking. They blamed the market, they blamed macroeconomics, they blamed their own timing. But a growing group of analysts, on-chain researchers, and Bitcoiners started digging, and they found a name, Jane Street. Chances are, unless you're deep in Wall Street circles, you've never heard of them. That's completely intentional. Jane Street does not advertise. Jane Street does not do press. Jane Street does not have a CEO. It barely has a website. For 25 years, it has operated in the shadows of the financial system. And it has become one of the most profitable trading firms on planet Earth. Let me give you some numbers to put this in perspective. In the second quarter of 2025 alone, Jane Street made $10.1 billion in trading revenue. In a single quarter, not a year. A quarter. That's more than Citigroup, more than Bank of America, more than almost every major Wall Street bank. From a company with 3,000 employees that most people have never heard of. How? High-frequency trading, algorithms, market making, they are what's called an authorized participant in the Bitcoin ETF market, which means they have special powers that you and I don't have. Powers that, according to some analysts, can be used to move markets. Before we go any deeper into the information pipeline that allegedly started this collapse, I want to see who is watching this right now. Wall Street operates in the shadows, but this community operates in the light. I want to see our global footprint. Drop a comment right now. Tell me your city and the exact local time you're seeing this. Is it sunrise in Miami, high noon in Chicago, or are the lights still on in Los Angeles and Austin? Let me know. And if you believe that transparency in these markets is the only way for retail investors to survive, hit the like button and subscribe. It's the only way we signal to the algorithm that we want the truth, not the narrative. Now, let's look at India, because this wasn't Jane Street's first time being caught in a pattern like this. But here's what I need you to understand. This isn't just about Bitcoin price charts and conspiracy theories on Twitter, because Jane Street is now being sued in federal court, and the accusations go back to 2022, to the single most devastating event in crypto history. I'll get there. But first, you need to understand the mechanism, how the 10 a.m. pattern worked. The mechanism. To understand what was allegedly happening, you need to understand how Bitcoin ETFs work, and why being an authorized participant gives certain firms an almost unfair structural advantage. When BlackRock launched its Bitcoin ETF, ticker IBIT, regular investors could now buy Bitcoin exposure through their brokerage accounts, without ever touching a crypto wallet. Billions flooded in. It was a massive success. But for the ETF to function, someone has to manage the plumbing. That's the authorized participant. Their job is to create new ETF shares when demand is high and redeem them when demand is low, keeping the ETF price aligned with the actual price of Bitcoin. Here's where it gets interesting. When there's high demand for the ETF and its price is trading above the actual Bitcoin price, an authorized participant can short ETF shares, essentially selling shares they don't yet have to bring the price back down. Under normal rules, short selling requires you to borrow shares first, but authorized participants are legally exempt from that requirement. They can short ETF shares without borrowing them. According to critics and analysts, including Jeff Park at Bitwise, this creates a structural mechanism, completely legal on its own, that can generate consistent downward pressure on Bitcoin's spot price at predictable times. Specifically, when ETF demand spikes in the first minutes of US market open, 10 o'clock in the morning. Balance note. Market data analyst Alex Kruger and others at CoinDesk argue there is no consistent 10 a.m. dump in on-chain data, and that the pattern is better explained by normal NASDAQ risk repricing. Jane Street has not commented on the Bitcoin allegations. The 10 a.m. manipulation theory remains unverified. Now, was this illegal? Was it intentional? Was it specifically designed to drive Bitcoin lower so they could accumulate cheaply? That's exactly what's being debated. That's exactly what analysts, traders, and lawyers are now trying to answer. But here's the thing about Jane Street that matters most right now. This isn't the first time they've been accused of this exact behavior, in a different market, with a different asset, with a different outcome. And that story is why there is now a lawsuit in a Manhattan federal court. Before we get to 2022, I need to tell you about India. Because in July 2025, the Securities and Exchange Board of India, one of the world's largest financial regulators, did something almost unprecedented. They suspended Jane Street from all trading in India and froze over $560 million in their accounts. Why? The regulator alleged that Jane Street was running what it called a morning pump, afternoon dump scheme on the Bank Nifty index. This is India's version of the S&P 500 for banking stocks. The scheme allegedly worked like this. In the morning, Jane Street's algorithm would buy massive quantities of bank stocks, driving the index up. At the same time, they'd take huge short positions in options that would profit if the index fell. Then, in the afternoon, they'd sell all the stocks, crashing the index, and collect on the shorts. SEBI calculated that Jane Street made approximately $4 billion from Indian markets between 2023 and 2025. During the same period, 93% of retail options traders in India lost money. The regulator's statement called Jane Street's behavior outrageous and said it showed the firm was not a bona fide market participant. Fact check. In July 2025, SEBI barred Jane Street from Indian markets, froze $566 million, and issued a 105-page injunction. The document detailed the alleged manipulation scheme. Jane Street deposited the funds into escrow while contesting the ruling. One regulator banning you could be bad luck. One lawsuit could be opportunistic. But here's a firm that has now been accused of the same type of behavior, using information advantages and algorithmic timing to exploit retail investors. In India, in the crypto ETF market, and in 2022, during what remains the single most catastrophic event in cryptocurrency history. Stick with me, because this next part is where it gets dark. May 2022. The night the crypto world burned. To understand the lawsuit, you have to understand what happened in May 2022. Because for hundreds of thousands of people around the world, it wasn't just a market event, it was a life-altering catastrophe. TerraUSD, known as UST, was the third largest stablecoin in the world. Stablecoins are supposed to maintain a value of exactly $1. UST used a complex algorithmic system to maintain its peg, paired with a sister token called Luna. The project was run by Do Kwon, a charismatic South Korean entrepreneur who would become one of the most famous figures in crypto. His followers called themselves lunatics. At its peak, the Terra ecosystem had a total market capitalization of over $58 billion. Luna was trading at $119 per token. Millions of people, ordinary people, factory workers, students, families in developing countries, had invested their savings. They believed they were holding something safe. They were wrong. On May 7th, 2022, something happened that triggered a chain of events that destroyed $40 to $60 billion in value in less than 72 hours. Luna went from $119 to essentially zero in a week. People who had put their life savings in were wiped out completely. A factory worker in Chicago named Hank Kennedy told Al Jazeera he lost $40,000, everything he had. South Korea estimated 28,000 of its citizens lost money. The contagion spread to Celsius, to Three Arrows capital, and eventually helped set the conditions for the collapse of FTX. The 2022 crypto winter was directly triggered by Terra's death. I want to pause here for a second, because numbers like $40 billion can make you feel nothing. Let me make it real. Somewhere in the world, there was a parent who had been saving money for their child's education, and what they believed was a dollar-pegged stablecoin. 1 week, gone. Not gone because the market went down. Gone because of what allegedly happened in the 10 minutes before anyone else knew what was coming. The 10 minutes that changed everything, according to the lawsuit filed in Manhattan Federal Court on February 23, 2026. Case number 1, 26 CV1504. Here is what allegedly happened on May 7, 2022. Terraform Labs, to try to stabilize the situation, quietly withdrew $150 million in UST from a major liquidity pool called Curve 3 Pool. This was an emergency internal measure. Nobody outside the company was supposed to know. 10 minutes later, 10 minutes, a wallet linked to Jane Street also withdrew $85 million from the same pool. How did they know? The lawsuit alleges it was because of an information pipeline that ran directly from inside Terraform into Jane Street's trading desks. The alleged source, a former Terraform intern named Bryce Pratt, who had later gone to work at Jane Street. According to the complaint, Pratt ran a private group chat called Bryce's Secret. This chat connected Jane Street traders with Terraform's internal staff, including software engineers and business operations people. They had a direct line to what was happening inside the project, before any public disclosure. The lawsuit claims that as Terraform's algorithmic stablecoin began to spiral, Jane Street used this advanced knowledge to exit its position, covering, according to the allegations, hundreds of millions of dollars in potential risk exposure at precisely the right time, just hours before the Terraform ecosystem collapsed. And then, this is what makes my blood boil. On May 9th, while UST was already trading at $0.80 and the system was visibly collapsing, Bryce Pratt sent a message in the group chat to Duquan and the Terraform team. He offered to buy Bitcoin and Luna at a significant discount. While the house was on fire, they were negotiating to buy the furniture. They exited their losses, and then they went shopping. The bigger pattern, jump trading, also named. And Jane Street wasn't alone. The same administrator, Todd Snyder, filed a separate lawsuit against jump trading in December 2025. Seeking $4 billion in damages, Jump is accused of a different but related scheme, allegedly helping inflate the value of TerraUSD before the collapse through a secret backdoor deal with Duquan, in exchange for acquiring 61 million Luna tokens at $0.40 each, when the market price was approximately $90. That's a discount of over 99%. Jump allegedly sold those tokens later, pocketing an estimated $1.28 billion. What's emerging, according to Snyder's lawsuits, is a picture where some of Wall Street's most sophisticated trading firms were sitting at the center of crypto's worst disaster, not as bystanders, but as allegedly informed participants with advance notice, using information that retail investors never had access to. The lawsuit drops, and something weird happens. The lawsuit was filed on February 23, 2026. Within hours, it was everywhere. Crypto Twitter, now X, exploded. The Glassnode co-founders posted about it. Sentiment tracked the sentiment shift in real time, and something strange happened in the market. Bitcoin, which had been grinding lower for months, which had been doing that 10 a.m. drop day after day, suddenly reversed. On Wednesday, February 25th, Bitcoin surged over 6% to nearly $70,000 in a single day. Zero Hedge posted a chart with the caption, "Would you look at that?" Traders noticed the pattern that had been so consistent for months, the morning drop, had vanished. Immediately after, the lawsuit headlines broke. Bitcoin went up the moment the world found out someone was being held accountable. Think about that for a second. The price of Bitcoin responded not to a policy change, not to an ETF filing, not to a tweet from Elon Musk, but to the news that a lawsuit had been filed. What does that tell you about what had been suppressing it? Jane Street deletes its entire Twitter X account. And then came the detail that made everything louder. On Wednesday night, Jane Street wiped its X account. All of it. Gone. A firm that had barely posted anything to begin with suddenly deleted its entire online presence on the same day the market reversed. Was it coincidence? Jane Street hasn't said. But in the court of public opinion, particularly on crypto Twitter, the timing was noticed, shared, and screenshotted thousands of times. Fact check. Jane Street deleted all posts from its X account following the lawsuit headlines per StockTwits and Gadget Review reporting. The timing coincided with Bitcoin's 6% surge. Jane Street's official response to the Terra lawsuit called it desperate and baseless, attributing Terra's failure to a multi-billion-dollar fraud perpetrated by the management of Terraform Labs. Source: Fortune, CoinDesk, and StockTwits. What Jane Street says, their side now. I have to give you the other side, because this is what responsible analysis looks like, and because you deserve the full picture. Jane Street, through a spokesman, called the Terra lawsuit a desperate and baseless attempt to extract money. Their position: the losses suffered by Terra and Luna holders were the result of a multi-billion-dollar fraud perpetrated by the management of Terraform Labs. And Duquan, who is now serving a 15-year prison sentence, confirms that much is true. On the Bitcoin manipulation allegations, sources close to Jane Street described the claims as absolutely ridiculous. Multiple analysts agree. Crypto economist Alex Kruger looked at the data and found no consistent 10 a.m. Bitcoin dump. Jeff Park at Bitwise argues the trading patterns are better explained by the legal mechanics of how authorized participants manage ETF share creation and redemption, a process that happens across multiple firms simultaneously, not just Jane Street. Fortune magazine ran a piece calling the Bitcoin conspiracy flimsy at best, quoting a Wall Street veteran who said, "It's just people who don't understand markets and want there to be a boogeyman to blame for why they haven't made more money." I want to be honest with you. The Bitcoin 10 a.m. dump theory is unproven. There's no smoking gun in the on-chain data. The Terra allegations are the ones with legal teeth, and those are still just allegations. Courts will decide. But here's what I find undeniable. Jane Street was banned from India's market for behavior that looks structurally similar. They are named in a federal lawsuit. A former employee allegedly ran a secret information pipeline from inside a crypto project. The price of Bitcoin reversed the day the story broke. You decide what to make of that. The IBIT position, what they were building. While all of this was happening, here's what Jane Street was doing on the other side of the trade. According to regulatory filings, at one point they held nearly $2.5 billion in BlackRock's IBIT, the Bitcoin ETF. They added $276 million in quarter 4 of 2025 alone. They were also accumulating massive positions in MicroStrategy, the company that has been buying Bitcoin at scale since 2020. Critics argue the strategy was a deliberate loop. Depress spot Bitcoin prices through ETF mechanics, accumulate ETF shares and MSTR positions at lower prices, then profit from the eventual reversal. Defenders argue this is just smart market making, buying low, providing liquidity, and earning the spread. Both things can be true simultaneously. And that ambiguity, that space between legal and ethical, is exactly why this story matters so much. What this means for Bitcoin's price. Let's talk about what matters most for you right now, price. Where does Bitcoin go from here? The lawsuit has already had a measurable effect. Bitcoin bounced from a double bottom near $63,000. It is consolidating near $68,000 to $70,000 as of late February 2026. Analysts who follow on-chain data have identified what they call liquidity clusters. These are zones where large amounts of buy orders are stacked at $74,000 and $79,000. Ted Pillows, an analyst on X, pointed to the $79,000 zone as a potential near-term magnet. The logic? If the alleged suppression mechanism has paused, whether because of the lawsuit, public scrutiny, or a change in Jane Street's risk posture, then a natural price discovery process could resume and accelerate toward those liquidity levels. Price context, February 26th, 2026. Bitcoin recovering from $63,000 double bottom. Key resistance, $70,000, $74,000, and $79,000. Key support, $66,500, 4-hour 50, moving average. The 10 a.m. volatility pattern reportedly disappeared following lawsuit headlines. Multiple analysts are bullish on near-term recovery. This is not financial advice. Next, objectives. Lenayert Snyder, a trader who tracks institutional flow, noted that short-term direction is uncertain. This is given the recent massive bullish displacement. The next major liquidity target to the upside sits around $71,100. Above that, the $74,000 to $79,000 range becomes the objective. The bigger question, is crypto still a fair market? Here's the truth that this whole story forces you to confront. Crypto was supposed to be different. It was supposed to be the thing that retail investors could access on equal footing with institutions. No middlemen, no information asymmetry. Code is law. The Terra story, and now the Jane Street story, suggests that's not entirely true. Wall Street came into crypto, and it brought its methods with it. Authorized participant exemptions, high-frequency algorithms, information advantages through relationships with project insiders. The same playbook that has historically disadvantaged retail investors in traditional markets was imported into crypto. Does that mean you shouldn't invest in Bitcoin? No. Bitcoin is fundamentally different from Terra. It has no counterparty, no algorithm, and no insider with special access to a private group chat. Its supply is fixed. Its rules are transparent. What happened to Terra cannot happen to Bitcoin itself. But what this story does mean is that the Bitcoin ETF ecosystem comes with structural realities. The one that brought institutional money in and was supposed to legitimize everything favors sophisticated players. Authorized participants can short ETF shares without borrowing. Large players can create downward pressure at predictable times. And the people with the fastest computers and the best information will always have an edge. They will always be ahead of the person with a Coinbase app. If this story matters to you, if you think retail investors deserve to know when they're not playing on a level field, the best thing you can do right now is hit the like button. It sounds small, but it tells the algorithm this conversation is worth having. And it is. Here's what I want to know from you. Do you think Jane Street will be found guilty? Or do you think they're just being made the scapegoat for a broken system? Comment below. I read every single one, and I genuinely want to hear where you stand on this. This question is intentionally divisive. Half the audience will say, guilty, burn them. Half will say, this is a witch hunt. Both sides will argue. The algorithm rewards that. And look, if you know someone who lost money in 2022 with Terra Luna, or someone who's been watching their Bitcoin portfolio bleed and couldn't understand why, send them this video. Not because it'll get their money back, but because understanding what actually happened is the first step to not letting it happen again. If you want to keep following this, the lawsuit, what happens next with the price, and how institutions are positioning for the next run, subscribe. I cover this stuff every week with the same level of sourcing and analysis you got today. You deserve information that's actually researched. One last thing. The average watch time for a video like this is usually less than 5 minutes. But you stayed for the whole investigation. You sat through the court documents, the data, and the history. And that means you're not just a trader. You're a researcher. You have the attention span that Wall Street counts on you not having. You are officially part of the 1% who actually knows what's happening behind the curtain. If you made it to this final second, I want you to leave a comment with these 4 words. I see the machine. I read every single one of those, because those are the people this channel was built for. I'll see you in the next one, when we open the files on the jump trading lawsuit. Stay vigilant,